Hello students and welcome to this part 3 to standard costing. As promised, this is a 4-part mini-series and we have reached the third part, and today we will be looking at sales variances in this presentation. So the content of this presentation is that we are going to investigate the sales price variance and the sales volume variance. So there are two sales variances, and both of these variances will be explained in this set of slides. So I'm just going to jump right into the explanation. And the first sales variance is the sales price variance that I'm going to explain. So I start with this one because it's really very simple to calculate, and what you will do is you will use your block from the part 1 of the series that I've explained, and you will use that block to calculate your sales price variance. So this is very abstract when I'm explaining and I'm talking. At the end of the day, accounting is a practical subject. So I have brought an example here, and this is actually the exact example that we used in the other part as well. So it is the VUT example where we make a product and it has standard costs, and the actual results for the year is given. So this example would look slightly familiar to you. So what we want to highlight in this question is simply, information that relates to the sales price. And when I talk about the block, I refer to this block that I explained in part 1 of the series, where we calculated the material price variance and quantity variance, the labor rate variance and the labor efficiency variance, and also the variable overhead rate variance and the variable overhead efficiency variance. So if you're calculating your sales price variance, it is going to be calculated in this block, and I'm going to demonstrate to you now how it is done, and it is really, really simple. So I'm going to add here the sales price as one of the types that is calculated from block, and here we will now simply follow the instruction. The first column says actual units times standard cost per unit. So now instead of the cost, we will look at the standard price. So if I go back to my question, the actual units that were sold were 12,000 units, and the standard selling price was 62 Rand. So there I have my actual units and my standard price, and I am simply going to times it. So it's going to be 12,000 units times the 62 Rand. And if I look at the calculation, the answer there, I'm just pulling out my calculator as PowerPoint does not do these calculations for one. I get 744,000 Rand. Right, the second column, when we calculate the sales price variance, it will be left blank. So I'm just going to type blank, and let me explain why it is blank. The second column says actual input times standard cost per input. And as I explained previously, input is a meter, a liter, an hour, a machine hour, a labor hour, and the business will not sell these inputs. You don't sell meters of wood, you don't sell the labor hours, you don't sell the machine hours, you sell a complete product. So inputs are simply used to make a complete product, and then that complete product is sold. So therefore, because of inputs not being sold, we don't sell the meters of wood, no, we sell a complete table. For this reason, we don't use it as sales price because actual inputs are not disposable. Right, let's look at the actual results. For the actual results, we're going to go back to the question, and you will see that that would be, of course, now your actual selling price times your actual units, because actual times actual will give you the actual total. So there's the 12,000, and here I observed that the actual selling price was actually 65 Rand a unit. So I'm just also going to highlight that. So here I'm going to say again, it is actual 12,000 units. And I need to times it by the actual selling price, which was 65 Rand. If I do that math, I get an answer of 780,000 Rand. Right, so this is the line item that you add to this block in calculating your sales price variance. So we have not yet done it in totality. In your final answer, you will then say the following. In your final answer, you will argue as follows. This first column represents your budget because it is the actual units times the standard or budgeted price. And then this last column is, of course, the actual real world of what really happened. So now you will just argue with yourself to figure out if this is favorable or unfavorable. So the budget said that you have to make sales of 744,000 Rand. What you really made was sales of 780,000 Rand. So they asked for sales of 744. You made sales of 780. You will agree with me that you did better than the budget expected. If you were a sales rep and they tell you to make 744,000 Rand of sales and you make 780, you did better than they required of you. And therefore, that is favorable. So in your final answer, you are going to say sales price variance and you are going to take the 780,000, you are going to minus the 744,000 and your answer will be 36,000 Rand favorable. So it is that actual result minus that result at the standard price. That is simply how the sales price variance is calculated. It's very easy. You don't even have to worry about inputs. That one is just left blank. So it is just as straightforward as that. Right, moving along to the sales volume variance. This is a bit more tricky, or I will not say that it is tricky at all. It requires insight because if you're calculating the sales volume variance, you need to pay attention to whether the question is based on a marginal costing system or an absorption costing system. And that difference will cause a difference in the calculation that needs to be applied. So if we look at sales volume variance, it is the only variance for which I prescribe a formula because there's just no other way to do it. And really at this point, you must just study one single formula. I don't think that you're going to have a hard time remembering it. So if we look at the sales volume variance calculated under marginal costing, it is the following formula that will apply. Budgeted marginal income per unit times actual units minus budgeted units. So again, this will seem very abstract. You may not understand this formula upon seeing it for the first time. So again, I have copied this VUT example in here so that I can demonstrate to you what this formula means. Right, so let's calculate it. I am just going to copy the formula in, and then I'm going to show you how we are going to calculate it. I'm going to start with this part, the marginal income per unit. And I am going to first explain how we calculate that marginal income per unit. And I think then I will just show you the actual units and the budgeted units. You should not have too much trouble with that. And then we can continue. All right. So if I talk about the marginal income refers to situations where fixed costs are not yet minused. So it's not yet subtracted. So if I go to my information, I have a selling price, I have material, I have labor, I have variable overhead. Do you see that this example does not include fixed cost? Because for marginal costing, fixed costs must not be minused in calculating the sales volume variance. So what we will do is we are going to say, all right, the sales price, the budgeted sales price, please note, let me just include that. The budgeted sales price was, I believe, 62 Rand. Then we had some material that we have to minus. We had some labor. And we also had some variable overhead. Right, I'm just going to go back to the question. I can't exactly remember what the values were. So I'm just going to check them as part of this explanation. All right, so for the material, it seems to me the material was 20 Rand and 18 Rand for the labor. So I'm going to go for material. It was 20 Rand. I'm just going to say minus. For the labor, it was 18 Rand minus 18 Rand. And for the variable overhead, it was minus how much? 9 Rand. Right. Then I will get to my budgeted marginal income for a unit. And if I say 62 minus 20 minus 18 minus 9, I get to a total of 15 Rand. So 15 Rand, that is my budgeted marginal income per unit. So I'm going to use this information now. I'm just going to add a slide here. I'm going to use this total of 15 Rand in my formula now. So this formula said the budgeted marginal income times actual units minus budgeted units. That's the formula. So we just calculated our budgeted marginal income. It is 15 Rand. And then if we go back to the example, the actual and budgeted units are normally not too difficult to find. The actual units were 12,000 units and the budgeted units were 10,000 units. So we're going to say it is 12,000 units minus 10,000 units. And the answer there should be, if I type it into my calculator, I get 30,000 Rand. So the answer is a total of 30,000 Rand. I get a positive answer on my calculator, so therefore the sales volume variance is favorable. All right, so this is how we calculate the sales volume variance when marginal costing is applied. We do not minus fixed costs. We just calculate the marginal income without subtracting fixed costs. Then we can go and look at absorption costing. Absorption costing, of course, requires now that you do minus the fixed costs because it states in its formula, it changes the formula a little bit and it says when absorption costing is applied, we need to take the budgeted profit per unit and times it by actual units minus budgeted units. Then what does this mean? Again, I have copied the example in here and now you will see that the example has fixed overheads that were included under the budgeted cost. So now we need to apply the formula and minus the fixed cost to get to not marginal income, but rather budgeted profit. So if I'm just going to copy the formula in, and then we're going to solve it. So as you can see, it's really not hard. You just need to keep your mind together. So in calculating this budgeted profit per unit now, I am just inserting my shapes and nice things again so that you can follow my explanation. So the budgeted profit per unit is now calculated as your budgeted sales price for a unit. I believe that was 62 Rand. Then we minus the material. I think that was 20 Rand. And the labor, the budgeted labor, and the variable overhead. And now we also minus the fixed overhead. And we did not do this when we calculated marginal costing. So the material was 20 Rand. I'm just typing everything out so that you can follow my explanation. The labor was 18. The variable overhead was 9 Rand and the fixed was 3 Rand. If I now minus, of course, the material, I minus the labor, I minus the variable overhead, I minus the fixed overhead, I get my budgeted profit. Budgeted profit for a unit. And if I do that calculation, ladies and gents, I get to 12 Rand. 12 Rand budgeted profit. So now I need to go and apply this formula again. New slide, same formula. So now I'm going to say, all right, I know what the budgeted profit is. I just calculated it to be 12 Rand. What were the actual units? Actual units, if I go back to the example, were 12,000. Budgeted units, 10,000. I'm going to say 12,000 minus 10,000. And if I do that calculation, I get to an answer of 24,000 Rand. My answer is positive on my calculator, so therefore it is favorable. All right, so to recap, you need to calculate the sales price variance, which is very easy. You add it to the block from part 1. You simply apply the formulas as per the block. You leave actual input blank. Then the second type that you need to calculate is your sales volume variance. The sales volume variance and the way that it is calculated is affected by whether you are given marginal or absorption costing. If it is a marginal costing, it is the budgeted marginal income for a unit times the actual units minus budgeted units. In the example, I showed you that budgeted marginal income is the budgeted sales price minus material, labor, variable overhead. You do not minus the fixed overhead and you calculate budgeted marginal income. From that point, it's quite simple. You take the answer and you times it by actual units minus budgeted units, and these units are normally given. If it is your sales volume variance that you're calculating under absorption costing, you need to change that formula slightly and say budgeted profit per unit times actual units minus budgeted units. In the example, I demonstrated to you that you now also minus the budgeted fixed overhead per unit to get to a budgeted profit per unit. We took the answer, which happened to be 12 Rand, and we multiplied it by the actual units minus the budgeted units. If the answer on your calculator is positive, it is a favorable variance. If you type it into your calculator, you get a negative answer, it is an unfavorable variance. Alright, I hope that you have enjoyed this video. The sales variances are really not hard if you pay attention to the details. They are easy to calculate. It's just a lot of calculations to do. So you need to practice so that you are able to finish your tests. If you have any other queries, please send me an email with the questions that you are struggling with. And yes, that's it. And I hope that you have a great day. See you guys around.